The business sounds simple. People come in, they gamble, the math guarantees you keep a percentage of everything they wager, and money flows to the house every hour the doors are open. The house edge is not a metaphor. It is a mathematical constant embedded in every game on the floor. In blackjack, it runs between 0.5 and 2%. In roulette, 2.7 to 5.26%. In slots, anywhere from 2 to 15%. The casino does not need to be lucky. It needs volume and time, and the law of large numbers does the rest. Here is the number that ends the dream version of this story. In April 2012, the Revel Casino opened on the Atlantic City Boardwalk. It cost $2.4 billion to build. It had the most modern facilities, the most striking architecture, and some of the most innovative hospitality concepts the city had ever seen. It filed for bankruptcy 11 months after opening. It filed again 14 months after that. It closed permanently in September 2014, never having turned a single profitable quarter. $2.4 billion, 29 months, zero profit. Here is what this business actually cost to build, run, and survive. A land-based casino license in a major U.S. jurisdiction does not begin with a fee. It begins with an investigation. Gaming commissions conduct background checks on every key person in the ownership and management structure. Investors, executives, sometimes significant vendors. In Nevada, those background checks cost between $15,000 and $75,000 per individual. The application fee itself for an unrestricted Nevada license, $500,000, non-refundable. In states with newly established gaming markets, you also need a compliance consultant, someone who has navigated that state's specific regulatory requirements before. Budget, $75,000 to $200,000 for that role. Legal counsel for the application, gaming attorneys who specialize in state-specific licensing, another $100,000 to $400,000. Then factor in the 12 to 18 months between application and approval, during which you are paying staff, maintaining relationships, and generating zero revenue. Gaming commissions verify you have 6 to 12 months of operating expenses in reserve before they will grant approval. They will not license a casino that might go bankrupt mid-operation. Once licensed, the physical infrastructure, a casino management system, the technology backbone that handles slot accounting, drop and count procedures, cage operations, and compliance reporting, runs between $150,000 and $600,000 for the software alone. Integration and staff training, 6 to 8 additional weeks of labor costs before a single game goes live. The construction cost depends entirely on scale, but for a regional casino of any meaningful size, the pre-revenue capital requirement is staggering. Pre-opening costs, licensing, legal, construction oversight, staff hiring and training, reserve requirements, typically consume 60% of total startup capital before the doors open. The remaining 40% is your operational runway. That is the structure the Revel Casino entered on day one with. $2.4 billion in construction debt, a 6% mortgage rate, and a market that had already begun contracting. Nevada unrestricted license application fee, $500,000. Non-refundable background investigations per key person, $15,000, $75,000 each. Legal counsel for application, $100,000. Casino management system, $150,000. Pre-opening cost share, 60% of total startup capital. Before a casino generates its first dollar of revenue, it is already spending. The recurring cost stack is deep, layered, and almost entirely fixed, meaning it runs whether the floor is full or empty. Labor is the largest line. A management team, general manager, casino floor manager, compliance officer, finance director, runs $40,000 to $80,000 per month before a single dealer or slot attendant is on the floor. Gaming staff adds another $60,000 to $120,000 per month for a mid-size operation. Cage cashiers, surveillance operators, security personnel, hospitality and food service staff layer on top of that. For a regional casino employing 300 to 500 people, total monthly labor sits between $600,000 and $1.2 million. Slot machines do not depreciate on a hotel furniture schedule. A single modern video slot unit costs $12,000 to $25,000 to purchase. A modest floor of 300 machines requires $3.6 million to $7.5 million in hardware capital. Those machines carry a monthly maintenance and software licensing fee of between $50 and $200 per unit, $450,000 to $720,000 annually just in slot floor fees. Regulatory compliance is not a one-time cost. An AML compliance officer earns $90,000 to $140,000 annually. The software systems for transaction monitoring, suspicious activity report generation, and currency transaction reporting add another $30,000 to $80,000 per year. Annual third-party audits mandated by most gaming commissions, $20,000 to $60,000. Total compliance cost for a mid-size operator before any enforcement action, $200,000 to $300,000 per year. Utilities for a facility that runs 24 hours a day, 7 days a year, with dense lighting, climate-controlled gaming floors, hotel operations, restaurants, and entertainment spaces, average between $300,000 and $700,000 annually for a regional property. Property insurance, including the highly specialized gaming liability coverage, adds another $150,000 to $400,000 per year. Add together, labor at $8 million annually, slot maintenance at $600,000, compliance at $250,000, utilities at $500,000, insurance at $250,000, and you are at $9.6 million in annual fixed costs before you collect a single bet. Annual labor, 300 to 500 employees, $7.2 million, $0.4 million slot maintenance and software licensing, $450,000, $0.5 million WEIR AML compliance, staff plus systems plus audits, $200,000 to $300,000 WEIR utilities, 24/7 operation, $300,000, $700,000 WEIR gaming liability insurance, $150,000, $16.5 million before revenue. Now the revenue side, a slot bank of 300 machines, each averaging $300 per day in coin-in, total money wagered, generates $90,000 per day in handle. At a 5% house edge, gross gaming revenue from that slot floor is $4,500 per day, or $1.6 million per year. That is not profit. That is gross gaming revenue, the raw margin before the cost stack. Table games run on lower house edges but higher average bets. A blackjack table with an average bet of $75, 60 hands per hour, and a 1.5% house edge produces $67 per hour in theoretical win. 10 tables running 12 hours a day generates $8,040 per day, or $2.9 million per year. Add hotel revenue, food and beverage, entertainment, and parking, which in modern integrated properties contribute 40 to 50% of total revenue, and a regional casino with 300 slots and 10 table games generating a combined $3 million in gaming revenue might produce $5 million in total annual gross revenue. Against $8 to $10 million in fixed annual costs, that is a deficit before debt service, before taxes, before capital expenditures, and before the single largest variable cost, marketing and player incentives. Player comps, complimentary rooms, meals, and credits, average between 15 and 30% of gross gaming revenue in competitive markets. On $3 million in gaming revenue, that is $450,000 to $900,000 returned to players annually in free product. The net gaming margin for a regional U.S. operator, after comps, gaming taxes, which average roughly 20% of GGR in most states, and payment processing, is typically between 15 and 25% of gross gaming revenue. On $3 million in gaming GGR, net gaming revenue lands at $450,000 to $750,000. Then subtract operating costs. This is why the failure rate is structural, not accidental. A business that generates $3 million in gross gaming revenue keeps less than $750,000 after taxes and comps, before paying a single employee. That margin is what the entire cost stack runs on, and the cost stack is about to get more complicated. The house edge is a mathematical constant. The market it operates in is not. Atlantic City's total gaming revenue peaked at $5.2 billion in 2006. By 2013, it had fallen to $2.8 billion, a 46% decline in 7 years. The trigger was not a recession alone, though the Great Recession of 2008 accelerated the drop. The trigger was competition. Pennsylvania granted 5 casino licenses in December 2006. Those properties opened over the following years and captured the Philadelphia area gambling market that had been driving Atlantic City volume. By 2014, Pennsylvania had become the second highest earning casino state in the country, passing New Jersey. When the market contracts, the fixed cost stack does not. Labor does not automatically scale down because revenue fell. Debt service on construction financing does not pause. Regulatory fees do not decrease. The result is a margin that was already thin getting thinner, while costs hold. Between 2006 and 2014, 4 Atlantic City casinos closed. By 2016, 5 of the 12 that had operated at the market's peak were gone. The operators that survived were the ones with the lowest debt-to-revenue ratios and the most diversified non-gaming revenue. The operators that failed were the ones that had borrowed heavily against a revenue projection built on the 2006 peak. The volatility is not unique to Atlantic City. It is structural to the industry. When a new casino opens within 2 hours' drive of an existing property, the existing property typically loses between 10 and 20% of its gaming revenue in the first 12 months. That is not a projection. That is the consistent finding across market entry events in Connecticut, Pennsylvania, Maryland, Massachusetts, and Ohio over the last 2 decades. Every new license issued in a region is a direct threat to every existing operator in that drive market. Atlantic City peak revenue, 2006. $5.2 billion Atlantic City revenue by 2013. $2.8 billion. Down 46%. Casinos closed by 2016. 5 of 12 properties revenue lost. When new casino enters market, 10 to 20% in year 1. One of those closures was not a small or poorly run property. It was the largest, most expensive casino ever built on the Atlantic City boardwalk. Revel broke ground in 2007, just before the Great Recession. It ran out of construction capital halfway through and had to abandon plans for a second hotel tower while scrambling for the remaining $1 billion it needed to complete the project. When it opened in April 2012, it carried more than $1.5 billion in debt. The concept was deliberate and specific. Revel was designed as a resort that happened to have a casino rather than a casino that happened to have a hotel. It implemented Atlantic City's only complete smoking ban on its gaming floor, reasoning that the upscale demographic it was targeting would prefer it. It did not offer a traditional players club or comp card program, reasoning that its target customer did not need to be incentivized. It did not offer a buffet or bus programs that drove volume to other Atlantic City properties. It opened with boutique dining, luxury retail, and entertainment venues, in a market where most players had come for decades for the casino floor, the buffet, and the free drinks. Its first bankruptcy filing came in March 2013, 11 months after opening. At the time, the New Jersey Division of Gaming Enforcement data showed Revel generating the second lowest gambling revenue among the market's 12 operating casinos. The company listed debts of $1.52 billion and assets of $1.1 billion, already underwater on the balance sheet before the building was a year old. The restructuring reduced its debt by 82% through a debt-for-equity conversion. New management came in. New strategies were announced. None of it changed the fundamental problem, which was not management. It was the entry price. Revel needed a revenue threshold that the Atlantic City market, in 2012, with competition from Pennsylvania, a contracting consumer, and an already saturated luxury hotel segment, could not provide. The mathematics of its debt service required the property to outperform every other casino on the boardwalk from the first month of operation. It finished in the bottom 2. The second bankruptcy filing came in June 2014. The property closed permanently on September 2, 2014. It has never reopened as a casino. The building sat empty for years. This was not bad management. This was industry structure. There is a cost that never appears on a casino's opening day pro forma, and it materializes without warning at exactly the worst possible moment. It is the progressive jackpot liability. Progressive slot machines are linked in networks where a small percentage of every wager, typically between 1 and 5%, accumulates in a pooled jackpot that grows continuously until someone hits the winning combination. The casino does not book that accumulating liability as a current cost. It sits on the balance sheet as an obligation. When the jackpot hits, and statistically, it will, the payout comes directly from the operation's cash reserves. Walk through a specific transaction. A bank of 20 Wheel of Fortune-style progressive machines, each averaging $300 in coin-in per day, generates $6,000 daily across the bank. At a 2% progressive contribution rate, $120 per day flows into the jackpot pool. Over 60 days, that pool reaches $7,200 in casino-funded liability. The machines have also generated gross gaming revenue over those 60 days. Calculate it: 20 machines, $300 coin-in, 5% house edge, 60 days. That is $18,000 in gross gaming revenue. Subtract gaming tax at 20%, $3,600. Subtract the progressive liability at $7,200. Net contribution from that bank over 60 days, $7,200, or $120 per day per bank of 20 machines. Now the jackpot hits. A player wins $90,000. The progressive pool covers the first 7,200. The remaining 82,800 comes from operating cash. That single event has just consumed 11 months of net contribution from the entire machine bank. The transaction looked profitable every single day it was running. The jackpot payout revealed the true economics of the position. This is not an exotic scenario. It is the ordinary operation of a standard progressive slot floor. Progressive contribution rate. 1 to 5% of every wager goes to the pool. Example jackpot liability after 60 days. 20 machines. $7,200 pooled obligation jackpot payout. In example, $90,000 out of pocket above pool. $82,800 from operating cash. Months of net earnings consumed. 11 months from that machine bank. There is another cost growing faster than any other line item in casino operations. And in 2023 alone, it generated $440 million in penalties globally. Casinos handle more cash than almost any other legal business. That makes them structurally attractive to money laundering, a fact that regulators have known for decades, and that enforcement activity is now pricing aggressively. Under the U.S. Bank Secrecy Act, casinos are required to file a currency transaction report for every cash transaction above $10,000. They are required to file a suspicious activity report when a transaction raises specific red flags, regardless of the dollar amount. Failure to comply with either requirement can result in federal enforcement action. In 2023, gambling regulators globally issued fines totaling more than $440 million, with record-breaking penalties in Australia, the UK, and across Europe. Australia's Crown Resorts received a $450 million fine in 2023 for chronic AML failures that allowed suspicious transactions to go unreported for years. In the UK, William Hill Group received a record £19.2 million penalty, the largest in British gambling history at the time, for AML failures that included allowing a single customer to deposit £23,000 in 20 minutes, with no questions asked. Since 2022, the UK Gambling Commission alone has imposed over £75 million in penalties across dozens of cases. The compliance cost for a U.S. casino operator now includes a dedicated AML officer, a transaction monitoring software system, regular staff training on suspicious activity identification, third-party audit of BSA compliance programs, and legal counsel to review SAR and CTR filing practices. Total annual spend for a well-run mid-size operator, $200,000 to $300,000 per year. That is the cost of getting it right. The cost of getting it wrong is not linear. It is a single event. The AML Act of 2020 raised expectations and penalties simultaneously. A mid-size casino found to have inadequate AML controls today faces a fine that can range from tens of millions of dollars to license suspension. License suspension is not a setback, it is closure. Global Gambling AML Fines, 2023. $440 million Crown Resorts AML Fine, 2023. $450 million William Hill UK Fine, 2023. £19.2 million. Largest in UK history at the time CTR filing threshold. US. Cash transactions above $10,000 annual AML compliance cost. Mid-size operator. $200,000 2023 $100,000 risk of non-compliance. License suspension. Functional closure. There is a threshold in casino economics where scale begins to work in your favor, and it is much higher than most operators expect. Below that threshold, almost every fixed cost is punishing. Above it, a different set of problems emerges. What improves at scale? Marketing efficiency. A large integrated resort with a hotel, multiple restaurants, a concert venue, and a spa can spread customer acquisition costs across 7 or 8 revenue streams. A player who books a hotel room and buys 2 concert tickets has subsidized their visit before they sit at a table. The gaming revenue is almost bonus. At the Borgata in Atlantic City, which survived when its competitors closed, food and beverage and hotel revenue provided the cross-subsidy that kept the property viable through the market contraction that killed Revel. Borgata was also debt-light relative to Revel. It had the buffer. What gets harder at scale? Regulatory exposure. A property with 3,000 employees, 2,000 slot machines, and a hotel tower is a significantly more complex regulatory environment than a property with 300 machines and no hotel. More staff means more training requirements, more potential for compliance gaps, more BSA reporting obligations. The compliance team that costs $200,000 annually at a small property costs $1 million or more at a large one, and the penalties for a compliance failure at a large property scale proportionally with the volume of transactions that went unmonitored. The market power dynamic also shifts at scale. A small regional casino competes primarily on location and convenience. A large destination casino competes against Las Vegas, Macau, and every online gambling platform accessible from the same phone the player is using to navigate your parking garage. The competitive set expands as the property grows. At a certain size, this is a completely different business, one that requires hotel management expertise, entertainment booking, food and beverage operations, and a loyalty program sophisticated enough to retain a customer who has 17 alternatives within a 4-hour drive. The optimistic scenario: assume a regional casino, 300 slot machines, 10 table games, a 400-seat restaurant, and a 200-room hotel. Assume a market with no new competitive entrants in the first 5 years. Assume gaming volume at the midpoint of reasonable projections, slot coin-in of $90,000 per day, table drop of $40,000 per day. At industry standard hold rates, gross gaming revenue lands at approximately $5 million annually. Hotel and food and beverage adds another $3 million. Total annual gross revenue, $8 million. Subtract gaming tax at 20% of GGR, $1 million. Subtract comp costs at 20% of GGR, $1 million. Subtract labor at $8 million. Wait, labor alone exceeds total non-gaming revenue. This is the structural reality even in an optimistic scenario. Optimize. Assume a leaner labor model at $6 million annually, utilities at $400,000, compliance at $250,000, slot maintenance at $500,000, insurance at $250,000, total operating cost, $7.4 million, net operating income before debt service, $600,000. On a property that costs $20 to $30 million to build and equip, that is a 2 to 3% cash-on-cash return. Before debt service. The realistic scenario. Now introduce one bad contract. The property signed a 5-year lease on its slot machines from a third-party vendor rather than purchasing. The monthly lease payment is $40,000 per machine on 200 units. That is $800,000 per month, or $9.6 million annually. Add one lawsuit. A guest slips in the parking structure. Medical bills, liability claim, and legal defense run $400,000 over 18 months. Add one equipment failure. The casino management system crashes during a weekend of peak volume. Emergency IT vendor, data recovery, and regulatory reporting obligations for the compliance gap, $280,000. Recalculate. Net operating income from the optimistic scenario was $600,000. The machine lease delta alone, the difference between owning and leasing, adds $9.6 million in annual cost. The lawsuit consumes the entire year's net income and legal fees. The equipment failure consumes another chunk. The realistic scenario does not produce a net operating loss from exotic disasters. It produces a loss from 3 events: a lease structure, a slip and fall, and an IT failure that happen to someone in this industry every single week. The American Gaming Association's research consistently shows that the primary cause of casino failure is not bad management or poor customer service. It is debt-to-revenue ratio at opening. The properties that survive market contractions are the ones that opened with the lowest leverage relative to their stabilized revenue expectations. Every casino that closed in Atlantic City between 2014 and 2016 carried debt service obligations that required top-decile revenue performance in a market that was contracting. None of them had the financial cushion to perform at the median. The operators who consistently survive share 5 observable operational habits. None of them are motivational. All of them are structural. First, they own their machines rather than leasing them. The capital requirement is higher at opening, but the operating cost, delta over a 5-year period, is the difference between a profitable and an unprofitable floor. Second, they maintain compliance staff before they are required to, not in response to a regulatory inquiry. The casinos that received the largest AML fines had compliance teams that were understaffed relative to transaction volume for years before enforcement action. The cost of proactive compliance is $250,000 per year. The cost of reactive compliance starts at several million. Third, they treat non-gaming revenue as the business, not the amenity. The Borgata's restaurant revenue and hotel occupancy were not marketing expenses to attract gamblers. They were profit centers that cross-subsidized the gaming floor during revenue contractions. Fourth, They maintain a minimum of 12 months of operating expenses and liquid reserves at all times, independent of their credit facility. Gaming commissions require 6 months. The survivors hold 12. Fifth, they never project revenue based on a market peak. Pro formas built on the highest performing comparable property in the market, not the median performer, produce capital structures that cannot survive a contraction. Every one of these is a finance decision made before opening. None of them can be corrected after the fact. At the beginning of this video, the business sounded simple. People come in, the math guarantees you keep a percentage, money flows to the house. What the economics actually show is a business where the entry cost runs into hundreds of millions of dollars. The fixed cost stack consumes most of the gross margin before debt service. The net margin is thin enough to be destroyed by a slip and fall or a software failure, and the single largest external risk, a competitor opening within 2 hours' drive, is outside your control entirely. The Revel Casino spent $2.4 billion to prove that the house edge is not enough. You also need the right market, the right capital structure, and 12 months of reserve the day you open. If you want the breakdown of who actually profits from casino economics, because someone always does, that video is here. Subscribe if the numbers in this one were useful.